Welcome to Investors Edge, powered by SNL. Today, we have a distinguished guest who has left an indelible mark on the startup ecosystem. He is the founder and CEO of Consultancy Ventures, an award winning entrepreneur, and a sought after thought leader. With a career spanning diverse sectors and accolades that include Best Startup Supporter and Entrepreneur of the Year, our guest has dedicated his expertise to supporting startups and growth stage companies across the globe. He has been a venture advisor with Loyal VC, a mentor and speaker at prestigious institutions, and a familiar face on top tier business news channels. With a commitment to bring change makers accelerate their dreams through venture capital, angel investment, and strategic services, he has forged connections with over 450 investors and VC world funds worldwide. Please welcome Mr. Tushar Kansal.
Thank you so much, Priyanshi. It's a pleasure to be talking to you today, and this exciting world of startups and funding, and everybody is so enamored with it. So I thank you for having me on your podcast.
Yeah, definitely. To get started, we all want to know the story behind Consultancy Ventures and what inspired you to start this.
Well, I was, after my engineering and MBA and doing a executive course from Harvard Business School, I was in corporates. I was in Deloitte and Touche doing financial advisory, and I could understand that what it means to earn from the balance sheet side of things rather than the profit and loss side of things. And and then I was a part of the team at Brand Capital, which is Times of India's venture arm. And I was fortunate enough to be, having taken part in investing almost 100 crores across many companies. Then, I moved to Treasuries, Aircel, which was a large treasury, and then I raised $2.5 billion of debt for the Russian telecom company MTS. And lastly, I was CFO of a company which was owned by the American private equity fund Guggenheim Partners. So while I did all that, I thought that I've done my part in the corporate finance space, and then I wanted to start on my own. So I did start on my own in 2014. But that was a product company in B2B space, and I was coming from almost 15 years of non-stop finance work, and and I had to do marketing there, go to Africa, US, get the deals done on hair extensions. I didn't like it much, and then I said that it's a very small life. If I have learned something for 15 years, why should I not be doing that? And then I in 2016 I started Consultancy Ventures, and I was always very convinced about the strong economic and financial rationale of earning through the balance sheet side of things, which is by way of investments. And when in 2016 when I started off, then there were 436 startups registered with the Startup India. Today there are more than 100,000.
Wow.
So I was bang at the right time at the right place, and I kept my mind open. Like, people had no idea what is startup investing, and it's only today that a lot of them have seen Shark Tank and they can talk about investing and startups. But we were there when we had to explain people what a startup means.
Yes.
And I was very fortunate. Like, I did almost more than 300 talks, webinars, and events. All those videos are on YouTube and Google, and I was able to play my part. Today, I think in the last 8 years, we would have helped almost 5,000 startups achieve their aims. Besides providing them debt, consulting, being a virtual CFO, and also providing them strategic services like mergers and acquisitions. So this is the whole journey of 8 years in which I'm fortunate enough to have dealt with early stage and growth stage companies both.
I see. That's very impressive, Tushar. You've had a diverse career, as you said, with Deloitte, MTS India, Guggenheim Partners, and also been a founder yourself. How have these different roles and industries shaped your approach to venture capital and entrepreneurship today?
It's a very good question, Priyanshi. Actually, even in finance, there are different verticals. Like, you talk about the buy side in which you are investing money, or the sell side in which you are seeking money, or you are the consultant where you are in the mid side. So I was fortunate. I was a consultant in Deloitte and Touche. I did valuations, due diligence, private equity assignment, mergers and acquisitions, and I was able to appreciate the consultant side of things, which is the mid side. And from then on, I moved to the buy side, which was the brand capital, and I actually saw that what it means to invest money in some other company and what it takes, because although you get a lot of limelight when you are on the buy side of things, but the decision matters a lot. So you have to be really very sure of why you wanting to invest. So I learned it there, and then I was in treasuries, so I learned how to manage cash, how to put money, invest in liquid funds, mutual funds, FDs, how to do forex transactions, how to do cash management, and then at MTS, the company was ranked 11th out of 11 telecom companies, and they were not getting any debt in India. And being Russians, they always thought that India will support them a lot. So I came in and in 3 years raised almost $2.5 billion for them, including 2,600 crores from State Bank of India, 500 from Central Bank of India, 1,240 crores from Deutsche Bank, 1,300 crores from ING Vestia, then Bank of China, China Development Bank, $850 million. And we did all those things. And finally, it was my best job because I learned how to raise funds, which, even they were debt funds, but they were structured deals in many cases, and cross-border structured deals. So from there on, moving as a CFO of a 1,500 crore company, which was owned by the $200 billion Guggenheim Partners, I learned what it means to report to a fund. Like, how you present data, how you tell them what the story is, how you convince them on the returns, and things are beyond the financial model, because there is a story on which they have invested. So the stories should stay secular for them to make a return. And that's how I all through this journey, I was very fortunate that I actually learned all the aspects of finance, and I could see that investing is the real game, because any other business you might do within finance, you will earn a commission. But when you are investing, then all the economic forces and the government and the other stakeholders, they are aligned in such a way that you'll if you do it right, then you will end up earning the maximum, because the capital gains tax is the lowest across the world. In many countries it is zero.
Yep.
And also, this money, the valuation of companies are multiple of the action happening on the profit and loss side. So if a company is growing from 50 crores to 250 crores, the valuation will become exponential. So naturally, the return which you can make on the balance sheet side is like vastly more than what you can make as a profit if you were to invest that money in a business,
That makes sense.
in the profit and loss. So all these factors, and the fact that a large number of entrepreneurs, after they see success and they get a lot of money, they become investors themselves because they are able to understand the game. And all these countries with strong currencies, like the US with the dollar, Europeans with the euro, Japanese with the yen, all these currencies, they are basically, most of their economy is surrounded by services business, because they are managing this money. That is how they are running their economies. More than 70% of the US economy is managing the dollar. So I could see that why to be a part of the usual a normal founder journey. Why not, go full on and become an investor and then play with the money, become a money lender yourself.
Oh, you have been on both sides of the table. You've been an investor, you've been a founder. There is one question we often get from startup founders on some misconceptions that they have around raising venture capital. What is the right stage to do it? How to use it?
Well, you have to first of all think, through the hat of an investor. That the investor wants concrete things on the ground, and he understands, he or she, they understand the uncertainty, but end of the day they want to mitigate the risk. So what investors do is, either, nowadays everybody is an angel investor, a housewife, a CXO, industrialist. Everybody is an angel investor. So what I have seen successful investors do is that they never short circuit the process. So they will always give the documents to the analyst to so that they can get a report onto the view of the analyst, and when the analyst covers it, they cover all the parts like the market size and and the particular situation in which the sector is in that country, and what have the founders done till now to prove themselves, and all those things. So the second thing is that most of the investors feel comfortable in investing in a sector which they understand. So you have a banker sitting in Hong Kong, Singapore, or Dubai. They will always feel that we have dealt with this particular sector, so they can invest an amount, because each sector has its nuances and sectors go up and down, and it is very dependent on the geography also. So this is the second part, and the third thing is, of course, the cost of money. Like debt costs you in India 9 to 12%, but in the US it costs you 5 to 6%, and in yen it costs you maybe 2%. So that is, and hedge funds and private equity funds, they are allowed to take 90% leverage. So by investing $10, they can take $90 of debt. So when you understand cost of capital, you also have to understand the cost of equity. Because debt is one aspect. So equity is dependent on what is the returns which a particular stock market is giving. So US people invest in Apple, Amazon, and they expect that they will get an IRR, internal rate of return, of 35%, 50%, 60%. That is their expectation. So if you do the analysis from the stock market, there is a cost of equity. So if you are sure of what is the cost of money, then you will look for places which can give you sufficient return to cover for the cost, and that is where your alpha happens, like your skill, where you can spot the winners, you can and essentially you are betting on people, so your understanding of people has to be very strong, that what is the motivation of that founder, why is he in this business, is he just copying it from somewhere else to get venture capital, or is he really bothered about the problem he's solving? Because unless he's passionate, the journey is difficult, and it would be very difficult for them.
That's very helpful to hear. Coming back to the other side, startup founders often wonder what does it take to capture the attention of a VC? What advice can you offer to founders on how can they make their pitches stand out so they can attract potential investors?
Well, the pitch deck is essentially a journey of covering the entire aspect of that business. Majorly, what matters is, first of all, what has the founder done till now, and is he on a growth path, and that growth path can continue beyond the investment, and can grow even more. So that is one thing. The second thing is, what is the founder's background? Like, why people bet on IITs and IIMs and Ivy League colleges is because these people have proven themselves and they have gone ahead and, taken a risk and spent money, effort, and time to prove themselves. And if they are from a good college, the alumni network, I mean, that is the biggest thing. And the third thing is, what is the market size? If your market size is small, end of the day, your turnover will not increase beyond a point. So you have to understand the true, market size has been a big issue in India because people believe that we are a 400 million middle class and, the purchasing power, people have all kinds of figures. But the experience of e-commerce companies and social commerce companies, they have shown that the actual market is not so big, and the actual middle class which can spend on luxury and high priced products is in a range of maybe 10 to 15 crores maximum out of a population of 1.140 crores.
Wow.
So
Yes.
so these figures, and also look at India. I mean, the economic situation is good, the GDP is good, the inflation is controlled, the interest rates are not very high, but in the end of the day, the inflation is still there. It is not really very low. So the savings of the people right now is low. We are at a 30-year low in terms of family savings. So people are taking debt for consumption. So that is increasing leverage. Now this is going to reflect in the business of consumerist companies, the brands. So you have to really understand all these factors, put it in a pitch deck in terms of problem statement, solution, team. It has to be a healthy mix. Then the market size, some details about the product, then the 5-year projections, and covering also any competition you have, the competitors, and how you are different or better, and lastly, the amount of fund you want to raise and how will you deploy the fund. So, and basically, all these things, even the go to market, that also forms a part of the pitch deck.
That's very insightful, Tushar. One thing that you brought up is debt being used for consumption. From a founder's point of view, what advice would you like to give them in terms of debt versus equity, and how should they be using both type of investments in their expenses?
Well, in India, the way banking works, the banks always look for a cover in terms of real estate as a collateral, or some FD as a collateral, or some stock market investments as a collateral, because they understand that when a startup founder is taking debt, then it's the maximum risk. So, and it's not like the risk return scenario is very favorable for the bank. End of the day, if the company goes down, he loses the entire principal. But if the company goes up, he earns only 10 to 12% interest. But an equity investor, if the company grows, he earns 50% IRR, 35% IRR. So the banks in today's scenario, they are lending to startups, but they are innovating on the way they can recover the money. So revenue based financing has come in, for example, where it's entirely unsecured lending. They lend you a percentage of the revenue, but when it comes to getting back the money, then they will put a escrow on the payment gateway so that their interest and principal comes first.
I
So
see.
like they are trying to capture the cash flows of the startup, and so those innovations are there. And in what happens is, a founder does not have real estate because typically they are young people, and if they ask their parents for their real estate, naturally the risk part does not cover for the parents. So that is why that particular debt conundrum is there in India. But when you talk about US, if you look at Y Combinator, then what they do is they give you a term sheet initially, and they give you a term sheet which has convertibles. So if you return their money within 1 year, then there is an option that you can treat that money from Y Combinator as a debt and pay back with interest within
I
1 year.
see. I
Yeah.
see.
So companies, they have an incentive that they, do great in the first year and return the money to Y Combinator with interest. So those kind of structures are there. Is of course governed by the availability of cheap money, which is definitely, I think, 10 times more in US than as compared to India.
100%. I think even I have heard about collaterals being replaced by contracts in B2B scenarios for debt. And that's the same thing. They're bringing up innovative ways to finance while keeping their risk at check. So
Right.
you also mentioned something about a strong network, which comes automatically with prestigious institutions that you have proven in past. What strategies would you recommend to entrepreneurs to connect with potential investors and partners and build the strong network effectively?
See, when it comes to people who surround institutions which have money, like, typically you will see people, sometimes the wrong kind of people. So, they just want to, do a setting, or, get the monies by giving some commissions or stuff like that. So, you as a founder, you have to be seen, and you have to do a person who is genuinely interested in doing a startup. And so write blogs on medium.com, you do some podcast, if you're passionate about solving a particular problem, you write it about it on social media, you ask for the views of other people, be interactive, engage the entire community which is interested in that particular area. So you will be seen as a person who's fundamentally sound and who's genuinely interested in solving that particular problem. So money will chase you instead of you chasing the money. Secondly, some people are introverted. So, end of the day, it is good if you can go to events, exchange visiting cards, and, talk to the speakers who are out there, and personally go and meet them. There are a lot of people who want to help others. And, many times people are looking for mentoring assignments. And, that particular, nowadays, it is a trend to be mentoring against some benefit. So maybe you can shell out a small equity for the mentor, and all those things are there. But my advice to founder, one critical advice is, do have a Google presence. You should have a good website. Maybe your blog should be showing on Google, and then your YouTube presence should also be there. And anybody who searches your name, there has to be something in the first 10 results which shows what you are and what you are doing in life. So you have
Makes sense.
to leave your comfort zones. You have to move out and establish a sense in the market as to what you are and what you want to do.
I see. Coming back to consultancy ventures, your venture offers a number of services to startups. Can you tell us what specific ways your firm helps early stage companies and what sets you apart from other VC firms?
Well, we are a network of almost 500 VC funds and family offices. Apart from that, we have a tie-up with a huge number of financial institutions and banks and NBFCs, and so we cover all kinds of debt. And we are also partners with angel networks, including the top 10 ones. On the strategic side, we provide consulting services, virtual CFO services, and also mergers and acquisitions. So what happens is that many startups, if they are constricted in finding the right amount of capital at the right time, they look for some strategic play. So we have a good bandwidth and know-how in those areas as well. And we are venture advisors with Loyal VC, which is a Canadian venture capital fund, and have invested in more than 300 companies across 60 countries. We have also won 4 awards in our 8-year journey, including as the best startup supporter from the hands of Dr. Kiran Bedi for our work in the STEM field. Also, I have done more than 300 talks and events there on Google and YouTube, and I've been featured in a Har Ghar startup channel, which is on Tata Play. I've done Business Ki Pathshala, which are 9 episodes, and my life story was featured as the hustler in Har Ghar startup channel. So all these activities, they have been part of my own journey, and we helped the founders create their own journey as well.
Can you share some insights into the due diligence process that your venture follows when you're considering any investment opportunity? Like, what key factors do you evaluate in startups that they should be mindful of?
See, the due diligence happens in 4 areas. One is the founder background. So there will be calls made to people in the city the founder belongs to, and just to corroborate the journey which the founder has told us, and whether it matches with the real situation. Because we don't want founders who are de facto not truthful in the way they have represented themselves. Secondly, we do a compliance check, which means whether the company formation, the shares, and the capital table is, as per what the founders have given us. So this means checking with the registrar of companies, and a third is the accounting side of things, where we check with the accountant and we do a due diligence on the books of the company, whether the financial picture which the founder has told us is correct or not. And fourth, which is most neglected in many cases, is technology due diligence. So basically, whether the technology which everybody wants, right? We are generative AI, we are conversational AI. So what is the AI, right? I mean, we have found that the most genuine technology companies come out of Bangalore and Hyderabad. Although it's not a rule, but we have seen that, and including from places like T Hub in Hyderabad and IITs. So we do these due diligence, and what happens is that many times the longest due diligence happens to be on the technology side, because we really want to understand if there is intellectual property which the technology is creating. Because end of the day, if IP is there, then we have a fallback option. Like in case nothing goes well, we can sell the IP. We can build that clause in our shareholders agreement.
Makes
And
sense.
if things go well, the company can collateralize the IP and get cheap money from the government in any country.
Okay. What trends or emerging markets are you particularly excited about in the world of startups?
Uh, Good question, Priyanshi. So we are looking at companies which are rightly placed to capture the unique trends in each country. For example, in case it is artificial intelligence, then a consumer-facing company is more likely to benefit from data crunching and providing relevant data to the customers. And in case it is company in robotics, then of course India, we have such a huge population and unemployment as compared to China, which also has a huge unemployment. So naturally, the robo company will get better traction in countries which are utilizing the machine robots for manufacturing, for example. And thirdly, if it is a fintech company, then that country's regulators should be allowing a lot of space for the fintechs to compete with the banks. For example, just today, Slice, which is a fintech company which was in a bad situation, the Reserve Bank of India allowed Slice to buy a bank in the Northeast. So it is a big event, because this shows that the government is the Reserve Bank in India is fine for strong balance sheet fintech companies to buy out traditional loss making banks. So naturally this kind of even like in the case of lending tech in India, the RBI has come out with the rules which say that the lending platforms can utilize the balance sheet of non-banking finance companies provided they put up 5% of the lending amount as FLDG with the NBFCs. So this set a clear precedent for us to invest in lending tech companies. Then you have other areas like edtech, which is not doing well because people have moved from online in a large way back to offline. And then you have a host of other sectors like agri-tech. So, again, that is really dependent on the kind of subsidies which the governments are able to provide, because almost $800 billion worth of subsidies are provided by the US government alone to their farmers. Now, if any country has to compete with the US farmer, they have to get help from their government, because without that their cost of production will not be able to match up with the US. So all these factors, their economy is tightly interlinked with finance, and so we have to understand the whole narrative, the whole story of the founder, and match it with the fact that how much risk protection is there. For example, if the product has been made and MVP, minimum viable product, has been made, and a PMF has been achieved, product market fit, it means that there is a buyer for that particular product. So it makes sense to invest at that particular time, because that money will go in marketing and the revenue will increase and the valuation will increase. So all these things, so they help us identify the right investment.
That makes sense. Last question. As a thought leader and influencer in this space for so long, what is the key message or insights you would like to share with the next generation of founders listening to this podcast?
Well, I want to say that keep your mind open, keep your hearts open. You have to collaborate with a lot of people. In India, the mentality is I will create a 10 crore company, but I will keep 100% of equity with me. But in the US, the mentality is I will create a $1 trillion company, but I will have 15% of it. So you have to keep your heart and minds open. You have to collaborate with the stakeholders in the ecosystem. You have to. There is no there is no hard and fast rule that you have to do entrepreneurship. If it suits you, you do a job. In the senior level in the companies, the job is also like an entrepreneur, because they have to make business decisions like an entrepreneur. So maybe at a future point in time, you'll be better placed to identify a unique problem and a unique solution, and you'll be better placed to do entrepreneurship. So, do entrepreneurship only if you have the conviction, and because the journey is not easy, and you never forget that the whole ecosystem has a lot of agencies and parties which will help you. Like, we help with mentoring, we help with debt equity. So there are a lot of agencies which will help you out, so don't hesitate in taking help. That is my basic message to all the people who want to do entrepreneurship.
Thank you so much, Tushar. This has been an absolute delight.